Here today. My name is David Nage. I'm a managing director at ARCA. With me is Raoul Pal, a friend, and we're going to be talking to Raoul in a second. What I wanted to do was thank you all and give you a little context as to why we are here today. FO256 was started in 2018 to help create an environment to help facilitate the education of digital assets, void of sponsors and fees, bringing the best investors and founders together to share their experience and knowledge. What a year it's been since we last saw many of you. Our world has been ravaged by a global pandemic killing millions, while science has come up with a vaccine in the fastest time in history thanks to our understanding of genomics. We here in the States are still dealing with the issues of social injustice and trying to find a way for us all to heal and work as one. So many pronounced social and economic issues have been dealt with this last year, and during that time, many have begun paying attention to the world of decentralized and distributed systems that are the backbone of Bitcoin, Ethereum, and the world of digital assets. Since the first FO256, we have seen a lot of progress. At the time, Bitcoin was trading around $7,400 in 2018 and hadn't caught the attention of firms like Morgan Stanley, JP Morgan, Goldman Sachs, and historic investors like Paul Tudor Jones, Ray Dalio, Stanley Druckenmiller, and others. Ethereum was hovering around $250, and sectors such as DeFi were just starting to be created by some of the most amazing founders currently in the space. Since last year's FO256, Bitcoin has climbed over 340% and Ethereum over 1,200%. Besides price, there have been a significant growth in sectors throughout the asset class. Decentralized finance was hovering around $800 million in total value locked. Today is currently sitting at $56 billion. Decentralized exchanges have become viable options for those participating in this market, highlighted by some of the structural issues over the last 2 weeks. Over 46 billion in volume over the last 7 days has occurred on some of these exchanges. The rise of NFTs has caught the attention of the world after people sold a piece of digital art for over $69 million in an auction. We have come a long way, but I know many of you today are thinking about the last 2 weeks. Today, some of the best investors and founders will share their insight, their endeavors, and highlight why some of the most renowned investors of our time continue to invest in this new emerging asset class. With that, it's my pleasure to introduce Raoul Pal, CEO and co-founder of Real Vision Group and Global Macro Investors. Prior, Raoul was co-manager of the GLG Global Macro Fund in London. In 2004, he retired from fund management and started the Global Macro Investor in January of 2005. He was one of the relatively small number of investors to predict the mortgage crisis of 2008 and 2009. He was co-head of hedge fund sales in equities and equity derivatives at Goldman Sachs in Europe, based in London. With that, Raoul, good to see you again.
Good to see you, my friend, as always.
So, a lot to deal with today, a lot to unpack. I think what we'd like to do, and especially with you after I've gotten to know you for a few years, is almost like a doctor's visit. Where are we today? What is the health of the overall system, if you could? We're going to talk about central banks debasing fiat, if that's really the story here. We're going to talk about the last 10 years of technological changes in history. But if you had to give an assessment of health of the overall markets out there, especially from a global macro perspective, China, the US, emerging markets, how are we looking today from a bond perspective, from an equity perspective? How are we looking today?
So I think it's interesting. We've just had the biggest recession in pretty much global recorded history. And what happened is assets went down for a month and then rocketed higher, which kind of left many people by surprise because the pain was real. The Main Street pain was real. The insolvencies were real. The job losses were real. But that wasn't reflected in anything. And what that was a function of was really the fact that the central banks, obviously, and the governments took unprecedented measures, which was unprecedented monetary printing, along with unprecedented stimulus. Direct payments. These are all really new things, essentially. And the net effect of that was that assets went up, but wages didn't go up, and a whole bunch of other stuff didn't go up. So what was that all about? That was actually about something you alluded to a minute ago, was actually the value of fiat currency fell. So the denominator for assets fell because those things are relatively fixed. So if you look at anything with a relatively fixed supply, whether it's equities, fixed income, equities, real estate, gold, crypto, it all exploded higher. Anything with variable inputs, such as corporate earnings over time or wages didn't really go anywhere. And that was really interesting. And it's to do with this kind of denominator effect that I call it. So many people watching this will be familiar with the charts of the Venezuelan stock market going vertical. And once you adjust it from bolivars into US dollars, the actual market went down. And that's the same thing. When you look at asset prices over this period, they basically went down and went back up into the middle of the range versus the Fed balance sheet or the central bank balance sheets. So I think that's a key function of this market. So now we're in recovery phase, post-crisis. Normally, this phase would be an 18-month bottoming process in markets. But because of this denominator effect, markets have gone higher anyway. So now we've got supply-side bottlenecks that are creating huge rises in some commodities, such as agricultural commodities and oil markets. So that's an interesting point. Other markets like copper are seeing an entire demand shift that's coming from EV and the kind of drive towards green energy, which is another trend we'll talk about in a bit. So we've got what seems to be inflationary pressures, and everybody's freaking out. The bond market's going to collapse, and guess what? The bond market just went sideways. Really, it backed up a bit, went sideways. Could it move? Could yields go up a little bit more? Yes, but what we've got something interesting is if yields went up a lot, i.e. inflation was sticky and massive, well, then the Fed were going to intervene with yield curve control. What yield curve control would do would be more printing of money, and therefore more of these assets go up. So we've got this weird cycle. If the economy slows down, which I think it will do in the second part of this year, and inflation will surprise to the downside, it's not going to be as strong as people expect. Well, the likelihood is, knowing every single recession, the Fed have generally ended up cutting or stimulating at least 18 months after it. So the odds on chance are that they do it again. So again, that drives up assets, which is a weird world that assets almost can't go down in price. I know that sounds ridiculous,
right?
But this is the kind of world we've got into. So that's the other global macro, just to give the last global macro bit, is the dollar. There is a generalized consensus. In fact, 100% of Wall Street analysts suggest the dollar's going lower this year. I know it's the bottom end of the range as we're speaking now. My guess is it'll probably be in the middle of the range by the end of the year, and people will have got that one wrong too. It's pretty consistent that people get those kind of bets wrong, particularly when there's such consensus around, the dollar's going to collapse.
Right.
I don't think that's the case.
And there's a reason why, as many people may be listening right now, they think that we're going to be talking solely about digital assets. But from our perspective, as Arca is a digital asset management firm in this world, and my team comes from a global macro perspective where we've traded everything from equity and bonds, and now obviously have spent the last few years in digital assets. Understanding these frameworks is incredibly important for understanding the world of digital assets and where it fits in a portfolio. And so I'm curious, as you think about the pandemic, as I alluded to in my intro, obviously has been dire for many people, especially now in India, where we're seeing that obviously continue to escalate. We see that bonds, especially in India, continue to have very high yields. And so I'm curious, how do you think the pandemic is going to shift this market narrative of inflationary issues, of concerns about the health of certain sovereign nations? How do you think that's going to change as we continue to have more vaccinated people out there, as we start to alludedly get to herd immunity? How does that shift things? There have been people out there, there have been some analysis out there that they think a demand pull inflation would happen, whereas people are now, flying, they're taking trips again, they're going on cruise ships, they're, out and about and they're shopping. How does that all interplay with the way that things go for the next 6 to 12 months?
I think the market is at peak inflation fear. But the bond market's giving you a signal. I always call it the bond market speaks the truth, right? Because the bond markets are basically, government bond markets and US government bond markets particularly, are basically GDP growth and inflation. Those are the two things, inflation expectations. Those are the two things that drive it. So everybody involved in the bond market's job is to massively analyze the economy, not corporate earnings, not sentiment, just these two things. And the bond market stopped going up in yields. As I said, could it go up a bit further? Maybe, but it's telling you that peak inflation sentiment is there. So I find that interesting. I also think, inflation looks hot now because of the year-on-year comparisons, because the world was shut this time last year and the world is reopening. So inflation will look pretty hot and heavy for a while, but is it meaningful? Are we going to see a massive ongoing change in, let's say, the structure of wages? Not in a world of technology, globalization, aging populations, where you've got two of the largest demographic bulges in history, both in the labor force at the same time. It's almost impossible. So if wages aren't going up, what's going to drive prices higher? Now, people say the Fed balance sheet, that doesn't drive the price of corn and stuff like that higher. Foodstuffs, that has been in a downtrend, inflation adjusted or outright, for basically decades now. So that's because of the rise of technology is increasing productivity of farmland.
So let's talk about that. So you just recently recorded a great video on Real Vision. I hope everyone checks that out. Fantastic content and education there, especially on the world of digital assets. So you've talked about a 10-year period of the largest technological change in history, where every car on the road is becoming obsolete today, where AI is going to intervene and we're going to have autonomous cars out there, Tesla, cracking the autonomous driving theme. And how you mentioned, we talked about at the beginning of the intro, how genomics has effectively ushered in the fastest deployment of a vaccine for this global pandemic. Talk about that, this 10-year period of the largest technological change.
So go back one step. So we've ascertained that the Fed balance sheet is actually falsely goosing the price of assets, right? Because the denominator's changed. It's not from liquidity of the Fed are printing money and people are buying the stock market, because stock market volumes have been falling for years. So it's not that. It's actually to do with this denominator effect. And the central banks are basically printing, on average, about 15% a year. So for you to make actual wealth, you need to beat 15%, because 15% of the stock market return is just the denominator. Okay, so how the hell do you make 15% in this world? Well, we all kind of know crypto, and we've all understood it. And we start to understand, and I've been a big driver behind it, people understanding network effects, exponential trends, and how that plays out. But in thinking about this whole denominator effect, I started to think about, okay, where can I get 15%? Well, that rules out pretty much most of the, major equity indices. It probably rules out the bond market, rules out the credit market, it rules out FX markets. There's pretty much nowhere to do it until you start thinking, maybe I can apply what I've learned in crypto. And I started thinking about things like Amazon and Apple and Google and Facebook, and realizing all of us macro guys got all of those wrong, every one of them. And I'll put my hand up. I got it wrong. It's a bubble. Amazon should not be trading a P of 600. Amazon is worth more than every other bookseller in the world. Remember, this sounds like Tesla, right? It's worth more than every other bookseller in the world. This is ridiculous. It's worth more than all the books ever printed. This is ridiculous. It's because Amazon was never a book company. It was a network. And once you understand that, you understand its valuation, which means it trends logarithmically. Thinking about that, it then dawned on me when I was looking at my door in Cayman. I put on a trade with regards to carbon credits in EU, and realizing in researching that investment, I realized that the EU and everybody else was extremely serious about the timelines of what they're going to do to create a green revolution. And then I looked at the door in Cayman. I thought, every one of these cars is gone in 10 years. They're everybody's going to buy new cars. And we're seeing the explosive rise of EV. And the governments are going to incentivize that. And then they're incentivizing investment in green technology. So we've got EVs, green technology, and on the top of it, why is Tesla worth more than all the other car companies? Well, because they're in with a potential chance, not a certainty, but the option of cracking autonomous vehicles. Or other uses of their car data network. At the same time, we're rolling out 5G globally. And in places that don't get 5G, maybe where you are in rural Pennsylvania or where I am in Cayman, I don't have it right now, but Starlink is coming. And not only is Starlink coming, which is another Elon Musk thing, not only Starlink coming, but there's 3 or 4 others coming across the world, spreading satellite Wi-Fi to everybody. So we're about to give the rest of the world, which is probably 2 billion people that don't have access to high-speed data, at extremely low cost. Then we've built a system of money that's based on this digital technology, which is all the crypto markets. Mm-hmm. Then we're adding in autonomous vehicles that will be using this 5G technology to navigate. Then you've got the rise of distributed computing power. Mm-hmm. So in the world of Moore's law, where's the power going to come from the semiconductors? Well, it's not. It's going to come from the network itself. So you can drive more computing power. So what does that mean? It means things like the Human Genome Project gets cracked super quick because you've got massive computing power, you've got massive access to data, and now you can apply another exponential trend, AI, to it. So we're now doing things at exponential rates. So we've got exponential adoption of exponential technologies that all interact into a larger network of the digital world, all at the same time within 10 years. Because every one of these is not now a pipe dream that they were 10 years ago, where we all started talking about them. They're all a reality. And there's a load more behind that. We've got robotics as well. We've got wearable devices, the Internet of Things. I mean, the list is kind of endless. So the world that we know today is going to be as different as the world was, probably more so. I think this will be the largest change in history. So more than the world we saw in 2000 and from 2000 to 2010, the change from 2020 to 30 is going to be absolutely ridiculous. And for me as a macro guy, I made my money basically trading the downside. You collect a bit of coupons on the upside and you make a killing when the concentrated returns came in downside because you could use options and leverage. But now we've got an opportunity as macro investors to invest in the upside, which most of us in crypto have got used to. It's that infinite call option in an exponential trend where you don't mind the volatility because it gets more than compensated in the returns. So that's where I think we're going. And so that's why it's very important, because the crypto revolution is part of this. It's all part of this same massive digitization of the world that is underway.
Mm-hmm. Talk about volatility. Howard Marks has had some pretty historic comments on volatility, how it's not a bad word. Talk about that. As someone who has been in markets for the last 30 odd years, talk about volatility. Is volatility a bad word?
Volatility is a bad word if it's suppressed. So when it's suppressed, you tend to get hyper volatility. And those things like often happen in credit markets. You know, you're making 3% returns and then you lose 50%, right? So the returns don't compensate for the risk. Volatility, particularly in these logarithmic or exponential trends, you tend to get compensated for the risk. Mm-hmm. So if I went back and actually did a Twitter post on this yesterday, if you look at the volatility in these network models, Facebook, Google, Amazon, they've had huge volatility.
Yep. But
the trend has been exponential. So you've been more than compensated. And Bitcoin's even more volatile and you've been even more compensated. So, you know, that's, some people can look at it as a sharp ratio, or you might look at it, if you look at the skew to the upside, a Sortino ratio, and of which Bitcoin is extremely powerful, and so is the whole crypto space. That's not to say everything's a winner, because you're going to have losers too. But overall, the space is growing exponentially.
So let's pivot to digital assets, to Bitcoin, Ethereum, and this world. Obviously addressing the 800-pound gorilla in the room. Obviously, the last 2 weeks has seen a reversal, if you will, episode that many of us in this space are familiar with, but many of those who have just started to come into this asset class over the last year are not that familiar with. And again, you know, hitting on the volatility. It's worth noting that there was some results from Ethereum as a network. You talked about networks. The total transaction fees, or the network revenue, increased 200 times to 1.7 billion in Q1 of 2021, compared with 8 million in Q1 of 2020. For the month of April, Ethereum generated annualized revenue run rate of 8.6 billion, comparable to AWS in 2015. The total transaction volume on Ethereum increased 20x to 713 billion in Q1 2021, compared to 33 billion in Q1 2020. We're seeing more transactions. We're seeing more daily active users. So with that in mind as a backdrop, what is your sentiment on the last 2 weeks relative to all the things that have occurred over the last year and a half or so?
If you don't factor in a 50% correction, you shouldn't be in crypto. That's one. Secondly, unless you know what the hell you're doing, you do not use leverage. It's fine. Those are the two simple rules. The rest is just hold on to your hats, expect the volatility, embrace it, because it gives you an opportunity to add to your positions. It gives an opportunity for the market to delever a bit, get rid of excess speculation that allows it to rise to the next level. But more important than that, I think a really big, important story, and I just tweeted about it just now. We just blew up $1 trillion of market cap of a major asset class in 14 days, 42% decline of an entire asset class. Some parts of that asset class went down 70 or 80% in a week, and nothing happened. We had a massive speculative over-leverage washout bloodbath. If that had happened in any other market in the world, there would be exchanges going under, participants going under, the Fed bailing them out, the system freezing, collateral freezing, funding freezing, lending free, all of that. Not one of those things happened. In fact, it worked perfectly because leverage, 100 times leverage, headline, oh my God, it's over collateralized. So guess what? Nobody was left holding the baby. There's no exchanges that didn't get paid their margin. It doesn't work that way. Had that happened in the stock market, Robin Hood will be tapping on the Fed saying, hey, listen, guys, we need some cash here because we didn't get paid on our margins. Doesn't happen in crypto. What about the rehypothecation of assets and the collateral? Doesn't happen in crypto because everybody knows who owns what, because it's all on the blockchain. In fact, lending protocols, DeFi, even decentralized exchanges run entirely by algorithms, continue to work.
That's right.
Exchanges went down for maybe an hour because of the overwhelming of their systems, but nothing broke. Nobody got caught holding the baby. Speculators lost money, and the world moved on. That is, I can't express how big a change that is to the world. This is why I got into crypto in 2012. That's what I first saw about it when I was researching deeply, having just gone through the European crisis and the 2008, thinking this system cannot survive. It's too fragile. And I saw Bitcoin and blockchain technology, and I thought this is anti-fragile, and we have just proven that in spades. It's amazing.
For those that are out there, hopefully Twitter is running ablaze because that was some incredible quotes and knowledge that you just dropped there. And I agree with you that this is anti-fragile. And you are correct, especially on the decentralized exchanges, as I mentioned in my intro, 46 billion in volume over the last 7 days, and they did not shut down. They ran as they are supposed to run. And so agree with you on that. You have been...
And also no systemic risk.
That's right.
Nobody in the traditional finance world nothing happened.
No. You have been a proponent of going beyond Bitcoin. Now, we at ARCA are very aligned with you, obviously, on that. We have seen this as an asset class where there are sectors where you can do fundamental analysis, and yes, you can, where you can do things like relative value. And so you have also been that proponent as well, too, seeing that this is a asset class. It is not a singular asset. And so I'm curious, how did you get to that point? And then after you answer that question, I want to alert everyone who's listening right now, you can send questions in. There is a Q&A feature here. So if you have questions for myself or Raoul, please send them through. We will try to address them in the next 20 minutes. But I want you to opine about this a little bit. Going beyond Bitcoin, how did you get to that mindset, especially in the face of some harsh criticism from those that do not believe that?
I knew that from when I first got into it. My kind of OG was a guy called Emil Woods. And Emil and Chad Cascarella were hedge fund guys, ex-Goldman guys, who Emil got me into Bitcoin back in 2012 and taught me through blockchain. So he first got me into Bitcoin and then taught me through blockchain. And then he was invested in stuff like Polkadot. God, before I even understood anything about it. But I realized that there was different elements to this and the smart contract elements. And then I started seeing, okay, and I've been writing about this for maybe 5 or 6 years, okay, everything's going to get tokenized. But that was easy to say, but you couldn't asset allocate to it. What we saw was the rise in clear macro thematics. DeFi was one, which we kind of knew was coming. We didn't know in what format. But things like, I mean, the things I'm really bullish about are community tokens. I'm really bullish about the Ethereum network for the reasons you talked about. If you value it as a network effect, it is exponential. And I think the Ethereum network may end up being worth more than the Bitcoin network. That's not a slur on Bitcoin. It's just different things. I just think that people say, oh, things are shitcoins, these tokens, they're worthless. People have no understanding what an NFT is and what power that is going to bring to every business model that you can possibly imagine. So this is a macro fundamental shift. There are sectors within it. I don't think people yet understand the metaverse and where that is all going. They don't understand communities. They don't understand NFTs. They don't understand tokenizing IP, tokenizing real estate. They don't understand a lot of this yet because people are still saying, should I buy Bitcoin? Are the government going to ban it? Meanwhile, as you well know, there is a massive, massive new world being built out. So it was that realization that made me realize that I didn't want to own just Bitcoin and I didn't want to own just Ethereum. Now, I don't know what's going to win in this because some things need to get network adoption. But I know some sectors are going to see massive inflows of capital and massive revolutions. So I'm happy to start allocating amongst sectors. I first approach it by buying a basket of altcoins outside of Bitcoin and Ethereum, equally weighted, saying, oh, look, I don't know which is which. You know, do I know whether Solarium or Cardano or Polkadot, you know, do I know? No, I don't know anything about them really. And it's not my job. I'm a macro guy. So I allocate to the space and say, I'll figure it out as we go, but let's get some allocation. And then I've started placing bets on things like exchanges, DeFi platforms, and the bit that's got my attention is the tokenization of communities and other business models.
We'll touch on that. I want to address a few questions, make sure that everyone feels that they're a part of this because this is for them, not just for us and our own edification. So Ross Murphy just asked a question I like. Hi, Raoul. How does the recent volatility impact inflows from institutions and corporations? Could this prevent many new entrants?
I don't think so. I think everybody knows that it's a volatile market. My guess is let's see how the recovery goes from this. If it goes quickly, you're going to see a blind panic. I know what people are like, right? If this goes back up quickly, there's going to be a blind panic into this. And quickly, I would say, if this is back to the highs in 2 to 3 months, there's a blind panic. So I think, again, the upside, everybody's short the call option, and they're going to have to buy them back. So that's how I think about it. The worst thing for crypto would be an 18-month sideways range, because that would keep people out because they don't get FOMO'd in, and it's not cheap enough for the value guys. So my view is the speed of the upside will bring people back in.
So another question from David Beer a few minutes ago. Bitcoin is considered by many an inflation hedge. And he believes that you may be more a deflationary proponent. Obviously, you can rebut that if that's the truth. How do you expect Bitcoin to perform in a deflationary environment?
First, I don't think anybody understands what is inflation and what they're talking about. I'm not saying he doesn't understand what he's talking about, meaning what inflation they are referring to. Because there's two different things here. One is the debasement of fiat currency, which looks like inflation of asset prices. The other is kind of demand-led increases in prices over time, which I don't see. I don't see monetary printing leading to excess consumption of corn or copper and stuff like that. I am a deflationist. And what happens when deflation comes? The central bank prints more money. And when the central bank prints more money, cryptocurrency goes up. It's a really simple mechanism. If you are ultra bullish crypto, what you actually want is rampant deflation, not inflation. You want rampant deflation, because that is when the central bank balance sheet keeps expanding. And I think we're still in a deflationary world. And I don't think that's going away, and that's not gone away, which is why every cycle, the Fed have to keep propping it up even after the recession.
That's good. So another question. I kind of like this question because it hits on something that we pride ourselves on at ARCA. The question is from Mark Irizarry. I apologize if I botched your last name there. Mark asks, active management probably matters more in the sector than any other. Are the growth of traditional asset managers and products like ETFs helpful in the space?
I think this will play out the way other markets play out. There'll be a time when macro is everything, and there's a time when bottoms up is everything. And I think that's great. ETFs in the space, well, they're just going to drive flows into the main protocols, and that's not going to change the value investing. Over time, things will change, but I think the big change that's to come is something I'm looking at, is there is limited real asset allocation from fund of funds, institutional investors into the hedge fund space yet, or the investment, the fund space within crypto. Most of those firms are like 40 million, 50 million. I mean, they're small. When that comes, we're going to see a huge rise in this stuff. And so I think there's a mega trend into, I've been a big fan and made no secret of ARCA for years from what you're doing. And I think, when you look back in 10 years' time and look at your asset base, you'll be laughing about what it is now.
Thank you for that. There are lots of questions in the Q&A about regulation. Now, I know you're not a lawyer, and I'm not expecting you to opine about the regulatory overhang that is today. There have been news reports over the last 2 weeks, especially regarding China, whether or not that is obviously an issue. But from your perspective, and we're going to have a regulation panel very shortly to address these issues from those that are lawyers and those that serve different companies in the space from a regulation standpoint. But from your perspective as a global macro investor, regulatory overhang, how does that affect you when you're looking at investments?
I look at it very differently to everybody else. If all of our jobs as nodes on the network is to increase network adoption, then you have to make it as easier for as many people to adopt it as possible. And I'm sorry if people have got an ideological standpoint on this, but the fact is if you want the massive savings pool that is everybody's pension systems and all of the capital, the RAAs and the wealth management space and the banks, you need regulation. And that's okay. And the crypto space, by its very mechanism, can also get around it too. And you'll be able to choose, and you'll get paid differently depending whether you want to take regulated or non-regulated, with the risk of non-regulated being prosecuted, whatever it may be. And again, it's difficult when you've got decentralized exchanges and stuff like that. How does it all take place? I don't know. But I think if governments are smart about it, they want their share. Because if you're still part of the population of a country and the country requires some tax receipts to be able to provide goods and services, then they will want to have that fair share. So they need to police the on-ramps and off-ramps.
Mm-hmm.
They actually don't seem to need to police the leverage, as we've just proven, because of the way it functions. But different countries will have different regulations. But in the end, all you're doing is allowing more people onto the network. That's the thing. So more regulation actually equals higher Bitcoin price, if you want to put it in simple terms. Less regulation is lower. It's network adoption models.
So
now, if you look at one thing, if you look at the growth of the internet from 1990 to 2000,
mm-hmm.
it grew at 63% a year in terms of number of users. The crypto markets are growing 113% since 2010, 2020. So it's growing at double the speed of the internet. It's the fastest growing adoption of any technology in history. If we even slow down from here to an 83% growth rate, so that's lowering by 20% a year growth rate, we get to 1 billion people using crypto by 2024. What's the value of that network then?
Big number.
It's a huge number. And that's without Facebook DM and the central bank digital currencies. So of course, there needs to be regulated, but it's unstoppable too.
So another question, again, we're going to have a panel on this, but a lot of people have been asking about this, and we're going to have a panel with Meltem Demures, Nick Carter, and a bunch of really fantastic people addressing the ESG concerns. But as a global macro investor,
I feel sorry for those two. They have to defend it all day and all night, but they're brilliant. I love them.
Their shoulders are heavy right now, but they're handling it well. And there are others out there, obviously, that are willing to take the weight with them too, like us. And so ESG has been something that has been brought to the attention because of certain tweets out there by certain CEOs and founders of certain company out there, and obviously the media paying attention to it. Not asking you to effectively, refute that, but again, we're thinking as a global macro investor and someone who has obviously spent a lot of time in digital assets. How do you think about it?
You've got an adoption problem that's been identified. I think it was actually raised by the ECB as a way to slow adoption, because they are the ones who've imposed most of the ESG mandates. So then they say, oh, but this doesn't meet your mandate. Phew, we can get on designing our central bank digital currencies and figuring out our regulations. Let's slow everybody down. Because of the network defense system that's embedded within cryptocurrencies, and particularly within Bitcoin, everyone's like, well, sod that, we'll try and solve it. And so, problem. And you can see people like Michael Saylor trying to find solutions to this. We can see what the miners are doing. We can even see, I think, China shutting down coal-using miners. So we're going to clear that hurdle. So if we clear that hurdle, if we've seen the problem, and it's a known known, and all of the smartest people in the world are working on this, what is the probability of that problem being solved? About 100%. So therefore, once people start realizing it's about to be solved, network adoption goes up. These are all good things. FUD is really important. It's really important because you're taking away obstacles, gently removing them, and allowing more adoption of the network. It's perfect. It's how it should work.
That's interesting. Obviously, I agree with that. I've also seen the likes of BlackRock and other large institutions, harping on ESG. You have Larry Fink, obviously, messaging their portfolio companies over the last few years to be focused more on this. And so we also have a generational transition from G1s, Generation 1s, who have amassed trillions of dollars of wealth that are passing to Generation 2s that are in their 30s, 40s, and 50s who are concerned about this. So I appreciate your thoughts on that as we move forward. I would say, a few other things that we are thinking about. When you think about application, you talked about networks a lot. When you think about actual application, you think about the world, and you think about 1 billion potential new users of the applications in this world. One of the things that brought me into this a few years back was the ability for those that are not part of the capital market system. They don't have a bank account. They don't have a identifier. They are effectively shunned from the capital markets, from investing. Do you see this as a thematic going forward, that this is going to drive more adoption, that as we see more and more utilization of DeFi platforms, as we see more and more utilization of the blockchain-based decentralized systems out there for identity, do you see this as some of the places that you'll see more adoption, or do you see other sectors in digital assets that are causing more adoption over the course of the next few years?
Look, everything's got adoption curves, so which is again what makes it so powerful. But we've had two big things that had to happen for this mega adoption to happen, right? We had, firstly, mobile phone networks. So pretty much most of the world is now saturated by mobile phones. Phase two is the data that we talked about earlier. And when 5G comes, even 3G is good enough, but 5G and the and satellite Wi-Fi means that you've now connected everybody. And so the adoption of digital money is obvious. And Facebook's going to drive this as well. Because you can be in Ethiopia, you can buy goods and services easily in US dollars that you have no access to from a global vendor You can send remittances to your parents in India from Ethiopia without any cross-border. I mean, oh my God. And that's just on the Facebook network, let alone all of the other crypto rails that are being built. So it's a game changer for emerging markets. It is a game changer for bringing people out of poverty and connecting them to markets and the exchange of value globally. It stops a farmer not getting access to prices. We've seen this in India, right? It's played out in India, but not with necessarily blockchain, but with their massive digital infrastructure, the UPS payment system and UPI payment system and stuff like that. Is basically you've got everybody in India on a mobile phone now with pretty much the cheapest data on earth. And now farmers are able to find localized market pricing so they don't get ripped off by middlemen. And so what it's doing is allowing profits to flow, less corruption going on. That gives them more money. They're now getting instant access to bank accounts. They're then able to transfer money. This whole thing balloons. And India is going to be the great example, but it's going to help everywhere. Countries are going to be able to mature at a much faster rate than we've ever seen in history. Doesn't mean the governments will mature, but people will.
Well, that's why having trust in code and math versus human psychology and the errors that we're prone to is important these days. I'm curious, we've talked about obviously where the adoption comes from. Interpret asks a question. In these current market conditions, obviously taking the last 2 weeks as a snapshot, but maybe potentially expanding that out for the next few years, what do you see as the top 3 risks that could potentially hamper the growth of the digital asset space?
I think the lack of expansion of the central bank balance sheet at some point in the next year or so will cause a slowdown, as it generally has done, because there's less pressing need to have your money shielded from that central bank balance sheet. So I think that is one thing. I think the rise of central bank digital currencies is on balance a good thing, but it depends what mechanism. I've talked about the biggest risk to me is not regulation, it's not banning, it's not any of these things. It's actually if the central banks got their shit together. If they created a global coin, and to be a member of Global Coin Basket, you could only increase your money supply by 2% a year. Well then, sure, we understand that governments are governments and they'll renege on their word, but if that lasts for 10 years, makes crypto adoption for Bitcoin perspective less valuable, but it explodes all of the other side. This is the thing about, we talk about things and people think about Bitcoin always, right? Well, we don't need the money then, the store of value. Well, I'm sorry, but Bitcoin is going to be dwarfed by the rest of this digital asset space. It's going to be much bigger because every business model on earth is about to be disrupted by all of what's going on. So even if Bitcoin itself doesn't go up, we will see a massive expansion in the space. Now, I understand that Bitcoin is the anchor asset and things revolve around it. Will that always be so? I don't think so, but maybe. Like the S&P is the anchor asset to world equity markets. That's okay. But it doesn't mean you're not going to have tons of opportunities. And exactly, again, without blowing your guys' trumpets, but that's why stuff like ARCA becomes very interesting over longer term cycles, because there will be points when projects have value and the market won't realize it because it's worried about Bitcoin going up and down. But that's the time when you guys have to do your homework. And that's good because there will still be alpha to be generated doing that. I strongly believe in that.
Correct. And that's one of the things that we definitely specialize in. And thank you for highlighting that. Last question. We started thinking in the beginning of this conversation as a kind of a checkup. How is the world doing from the global markets perspective? And so I'm going to end it thinking of the same way, Dr. Pal, if you will. You've given us a diagnosis. If you were to develop a portfolio today, think of it as, specific medications and therapies that I needed, how would you design the portfolio? If you were talking, as I know, you speak to some of the most prolific investors in the world, how would you, talk to them about portfolio allocation today, specifically also with the introduction of digital assets?
Almost everybody I know in the macro space is entirely in digital assets right now. Why? because the relative outperformance is so immense that you are doing your investors or yourself a disservice if you're not doing it. It's as simple as that. People don't get it. People are like, oh, Raoul, why don't you talk about bonds anymore? Why? Our job is to make money, right? Our job is to make money. And if I am choosing suboptimal assets, then I'm not doing my job. So right now, everybody I know, and literally everybody I know, is entirely focused on this space. Now, it won't always be so. And it won't always be so for me, because there'll be periods of time when it's going to get a lot harder. But that's when the exponential age thesis plays out, because we can use the skill set we've just learned from buying and holding a volatile exponential asset and apply it to a bunch of other technologies. That's really exciting to me. So I like holding, and not yet, I'm not ready to buy any of these yet. I'd rather be all in on digital assets. I'd rather make some tactical allocations across the sectors that we talked about. I'd like to have a concentration in Ethereum. I'd like to keep some Bitcoin. I'd like to let that play out. And then over time, I would think about replacing that allocation with kind of VC, the kind of value investing stuff that you guys do, maybe multi-strat hedge fund in the space, a broader perspective, because you're going to get some longer term bear markets, volatility. So you want to hand it over to people whose job is to manage that,
right,
and to look for opportunity. But meanwhile, diversifying into emerging markets and exponential technologies, with always an eye on the business cycle, because the business cycle is the key driver of assets. But we also know that if the business cycle gets ugly, the Fed print more. It's kind of this ridiculous situation where I don't see a downside. Yes, VAR shocks will happen. So don't come to me and say, well, the market sold off 20%, Raoul's an idiot. No, VAR shocks will happen, but things don't remain lower for longer. The only risk, really, for me, is a sideways risk market like equities. If the equities go sideways for 2 years, which happens from time to time, that's you're losing your 15% a year versus the central banks. That's quite painful.
With that, thank you, Raoul, so much for spending time with us this morning on this fantastic event. Your thoughts, your insight, your experience are so invaluable to many of those out there that are listening, to thousands that are listening out right now. And as always, I enjoy our chats about the world and about the markets. So thank you. Enjoy your time out there. Stay safe. The next panel is a fantastic one. Institutional investors, the likes of Morgan Stanley and Deloitte and others out there. We're going to be talking about institutions that are actually creating practices around digital assets. And so with that, I will depart. Thank you all for joining us today, and have a fantastic day.
Thanks, everyone.